Hey everyone, I'm Professor Stefan, and in this video we're going to wrap up our coverage of property, plant, and equipment. So let's get started. So we've covered quite a bit with PP&E so far, and in this video we are going to talk about what we do when the value of our assets fall, and what do we do when we sell these assets. So when the value of our assets changes, and we only care about downward changes in the value of our assets, if the value of our assets go up, we're just going to ignore that and proceed on with kind of everything we've learned. But if we think the value of our assets has potentially decreased kind of below what, we think those assets might earn for us, we're going to be in a scenario where we have to test these things for what we call impairment. And so the impairment tests follow a handful of steps. The first thing we're going to do is we're going to look for indicators of impairment. And this is kind of a qualitative assessment of, so we say, hey, have things changed? Is this asset really still worth what we claim it is on our books? So we haven't done any real tests yet. It's just a, hey, do we need to examine this more thoroughly is sort of what we're looking at. And if we say, no, everything seems to be fine. The market for whatever asset, whatever good this asset produces is still doing well. We're still generating revenues and profits from it. We think everything is okay. Then you're just done. But if you do have indicators that this asset might be impaired, you have to proceed on to a recoverability test. And our recoverability test is going to ask, is the asset actually impaired or not? And we're going to have to answer either yes or no. And if we answer yes, it is impaired, we're going to go on to our final step where we actually impair the asset, we take a loss, and we decrease its value. So we're going to get into some more depth of how these things work. So regarding our first question of indicators of impairment, where we're just looking at is, hey, do we need to do a full-on impairment test for this asset? What we're going to watch out for are kind of triggering events or changes in circumstances that might indicate some form of impairment. And these triggering events or changes in circumstances could be like declines in the market value of an asset. If you see, these things are, on fire sales everywhere. There could be a change in the legal or business climate. So if there's new regulations that kind of, hamper whatever good or service that asset is kind of producing, could change the value of it. Or if you're, not really selling much of the product that it's producing and you don't really see that turning around in the market, that may tell you that asset isn't worth kind of whatever it's valued at on your balance sheet. So if you determine that any of these indicators are present, and this is not an exhaustive list, this is just kind of the stuff you might want to think about. If you determine that there is some sort of indicator that your asset might be impaired, then we're going to proceed on to kind of step one of our impairment test, which is what we call the recoverability test. So the point of this test is to just answer yes or no. Is our asset impaired? So it's not going to tell us how much it's impaired by. All it is doing is answering yes, it's impaired, or no, it's not impaired. And we're going to compare two numbers here. We're going to compare the recoverable cost of the asset, and that is basically the undiscounted future cash flows that this asset will generate. So you make an estimate of, say, hey, this asset is going to bring in, $10,000 this year, $9,000 next year, maybe $5,000 the year after that. And so we add up all the cash flows we expect this asset to generate, and we just add them. We don't discount them or anything like that. We ignore time value of money for now. So the undiscounted future cash flows that the asset will generate, and we compare that to the book value of the asset. And remember, the book value or the net book value is the cost minus the current accumulated depreciation. And so if the cash flows that it's going to generate are less than the current book value that's on my balance sheet, that's going to tell us, yes, we are impaired, right? I'm not going to get enough cash out of that asset. That adds up to kind of what I'm currently claiming on my balance sheet that it's worth. And so if our cash flows are less than the book value, we say, yes, we're impaired, and we go to the next step. If we answer that no, we're actually going to generate more cash than the current book value. Then we say we're fine, and we just stop the impairment test right there. But let's say we're in the scenario where our cash flows are less than our book value. We have to go on to step two, which is where we actually impair the asset. And we're going to calculate how much we need to impair it by. And so our impairment loss is going to be the current book value minus the fair value of the asset. And so that would be like the market price of the asset. And if we don't have a market price, we could do a present value of the future cash flows. And our journal entry would be to debit some sort of impairment loss, some sort of expense on our income statement, and then we'll credit accumulated depreciation to bring our asset value down to the market value. So let's take a look at an example here. Let's say Surprise Inc. They have a specialized oven that makes pizzas, so they're selling pizzas as their business. And at the end of 2013, the cost basis was $18,000. So they paid $18,000 originally for this, and they have current accumulated depreciation of $4,000. Now that gives us a net book value of 14 grand. Now we're going to estimate, or we're going to try to figure out whether this asset is impaired. And so we're going to get some information on future cash flows. So over the next 4 years, they're expecting the following cash flows of 2 grand in 2014, 2,500 in 2015, 3,000 in 2016, and 3,500 in 2017. So over the next 4 years, this is going to generate $17,000 in cash, no discounts applied. And the fair value of the oven, kind of what they could sell it for today, is only $9,000. So to execute our impairment test, we're first going to look for those triggering events or indicators of impairment. And in this case, we're just going to assume that, hey, maybe pizza sales are down and we should look at the impairment for this oven. So if we answer yes, we have a triggering event, we're going to move on to step 1, which is the asset recoverability test. And this is where we compare the undiscounted future cash flows, in this case $11,000 from that prior slide, to the book value of the asset, kind of what it's listed at on our balance sheet right now, which was $14,000 from the prior slide. So our balance sheet is claiming the asset has a value of 14K, but it's only going to bring in cash of 11,000. So that's going to tell us that yes, we are in fact impaired. But remember, this first step does not tell us the amount of the impairment. All it does is tell us yes or no. And here we're answering yes, we are impaired. And so we're going to have to move to our second step where we actually calculate the impairment. So in our second step, we want to write down the book value of the asset down to its market value or its fair value. And so on the prior slide, we saw that the fair value of the asset was $9,000. So we have to bring the value of our asset from the $14,000 current book value down to the fair value of $9,000. And to do that, we have to record a loss of 5 grand and a credit to accumulated depreciation of 5 grand. And so you have to kind of make sure when you're looking at these problems, which numbers are undiscounted cash flows, that goes up into step 1, and which numbers are either fair values or market values or discounted cash flows, which is what we use in step 2 when we actually calculate the impairment expense. So that covers changes in the values of our assets and asset impairments. And so the last thing I want to talk about today is kind of the basic sale of an asset, what that journal entry looks like. So when we dispose of a long-term asset, we need to reflect this on our financial statements, kind of obviously, right? That's not really a surprise. And so our basic journal entry is going to have 3 parts when we sell an asset. First, we're going to remove the asset from our balance sheet, and we're going to remove both the asset kind of at cost, and we're going to remove its accumulated depreciation. Second, we're going to record any consideration that we receive if we're selling that asset, so any cash that we receive, and we're going to get into non-monetary exchanges in class, but we record kind of whatever we received in exchange for the sale of that asset. And then 3, we record if there is any gain or loss on that sale. And that's basically if the consideration we receive does not equal the book value, we're going to have a gain or loss. And just conceptually or kind of intuitively, what I want you to remember is that if I'm getting paid more, if my proceeds are more than the book value of the asset, then I have a gain. If the proceeds I receive or the consideration I receive is less than the book value, then I have a loss. So let's look at a simple example here. Let's say Regular Co. has a machine that costs them $100,000 and it's got $20,000 of accumulated depreciation. They decide for some reason they want to get rid of this asset and they sell it for $110,000 in cash. If we take a look at the numbers they give us, we can see that the net book value is $80,000, or it's that $100,000 cost minus my $20,000 in accumulated depreciation. I'm getting paid $110,000 for this, so my cash or my proceeds are $110K. And because my proceeds are more than my book value, that's kind of a good thing. And we have a $30,000 gain. So the gain is the difference between what I'm paid versus my kind of current book value of the asset. Now, when we record this entry, we're going to walk through those 3 steps, where first we remove the asset from our balance sheet. So we're going to credit the asset for the full $100,000 cost that we originally paid, because that was the amount that was sitting in that asset bucket. And we're also going to remove its accumulated depreciation. So remember, we removed the asset with a credit, and because the accumulated depreciation is normally a credit balance, we remove that with a debit. So these are going to be kind of the 2 lines we need for the removal of the asset. The third step is going to be recording the cash or the consideration that we received. So here we debit cash for $110,000 because that's what we got paid for this asset. And then step 3 is recording the gain or loss. And remember, gains are credits and losses are debits. So if you kind of remove the asset and you record how much you got paid, you can usually just plug the gain or loss as well to whatever you need to make the entry balance. Just a little tip in case you kind of get tripped up on exam and you forget how to calculate the gain or loss. You can write out the entry, and the gain or loss is just going to be the last piece that you need to make this entry work. So quick closing thoughts here. Remember, asset impairments are just write-downs of a book value of an asset down to the fair value. And we do that if the asset won't generate enough cash to kind of cover its book value, if it fails that asset recoverability test. PP&E can only be written down. We are never going to write that thing up for any reason. And when we sell PP&E, that's when we can kind of recognize that gain. So if the fair value has increased, we have to wait until we make that sale to get the gain because we won't write it up. And as one little tip here, just remember that when you're making a sale, you have to check if accumulated depreciation has been recorded for that given year. So there's a chance, if you sell something on say June 30th, halfway through the year, if you haven't yet recorded accumulated depreciation, you need to record depreciation for those 6 months. And that'll give you an updated accumulated depreciation for when you calculate kind of your gain or loss. Thanks for watching.